Welcome to the Free Cities podcast. My name is Timothy Allen, and this is the official podcast of the Free Cities Foundation. Hello, and welcome to episode number 102 of the Free Cities podcast. Hello indeed, from the extremely beautiful city of, you guessed it, Prague. I'm here, of course, for Liberty in Our Lifetime, which will be starting in just 2 days' time. I'm recording new episodes for the podcast, and tonight, I'm recording this intro for today's show instead of going out bowling with the rest of the Free Cities team on an evening social. Boo-hoo me, no rest for the wicked, as they say. It's all good though. This movement seems to be entering a new phase this year. New projects are popping up all over the place, and everyone I'm speaking to here has been commenting that there are so many things brewing or in the pipeline. It's amazing. Even Bitcoin's pumping at the moment. That always gives people a spring in their step, especially if you were listening to me at Liberty in Our Lifetime in 2023. Were you? That was a year ago. Remember what I said? Went something like, Bitcoin seems really cheap right now. It was, of course, under $20,000 at that particular time. That was October 2023. Do you know what it is now? It's over $70,000. So congrats if you took action back then. If you still need persuading, well, today's episode might help. I'm speaking to a gentleman by the name of Sam Roberts, who is a qualified actuary and director at Cartwright, the UK-based pensions and investment advisory firm. They serve institutional clients such as corporate pension schemes, charities, and corporate treasuries, etc. What's interesting for us, though, is that under the direction of Sam, Cartwright has become the first UK firm to make the pretty bold move of starting to advise their clients to allocate Bitcoin to their portfolios, part of the so-called arrival of institutions. And I'm doing inverted commas around that because I've been hearing that for so many years now. But anyway, apparently it's really happening. In this conversation, Sam and I discuss Bitcoin's role in pensions. He shares his journey from the 2008 crisis to viewing Bitcoin as a hedge against systemic risks. And we explore the challenges of integrating Bitcoin into the very slow-moving pensions industry. And much more, of course. Anyway, I've got to be quick. I've got to go. Got things to do, people to see. It's conference time. You know what it's like. If you see me, come up and say hello. I'll be around at the conference venue after the group photo on Friday lunchtime and some of the afternoon talks. Unfortunately, that's all the time I can spare away from this studio. But please don't forget to mingle yourselves. That's what this conference is all about. Everyone you need to speak to is probably already here right now. Mind you, what can you do about it now? Well, obviously, you can chill out right now. Forget your chores just for a couple of hours, and I'll advise you, in our time-honoured tradition, to just sit back, relax, and enjoy my conversation with Sam Roberts. Go. How's that? That's good. Right. Okay. So, Sam, I spoke to your colleague Glenn. It was about 3 months ago now. Very well received podcast. It got a lot of feedback, actually. And I think, like I was mentioning earlier, I think the reason that so many people liked that was that Glenn knows his stuff. But he was talking about something that is traditionally, a lot of people might think that's a bit boring. risk, pensions, things like that. Obviously, there's a Bitcoin slant to it also. We had a big conversation about Bitcoin. We don't necessarily need to have a big conversation about Bitcoin this time, but I'm absolutely I'm cool with that because I'm a Bitcoiner. I love talking about Bitcoin. But yeah, let's. What I thought we should do, since you both work together. First of all, why don't you introduce yourself, and then I'm going to ask you about some things that some questions I had that I didn't get around to asking Glenn, probably. So why don't you just give us a little bit of an intro about who you are?
Yeah, absolutely. So, and I can give a little bit about, I suppose, why I find myself in this room as well. Sort of lead into that. So, I'm Director of Investment Consulting at Cartwright, and we're a traditional pensions advisory firm. So it's all about delivering high quality actuarial investment, administration, consulting advice to corporate pension schemes. And we'll come back to that a little bit later because I think there's going to be some interesting angles on that. But in terms of me personally, so I suppose I feel that my journey started back in 2008, and obviously the global financial crisis. And that for me was the event which made me think, hang on a minute, something doesn't feel quite right. And it triggered me to go and research and just try and look everywhere I could for the answers. Why do we suddenly have this crash out of nowhere, I suppose, in particular? And through that, I ended up finding Austrian economics. And it was like the veil had been lifted from my eyes. It was suddenly everything now makes sense when looked at through Austrian economics. So I dove pretty heavily into trying to understand where they came from on different topics. One of the things that particularly struck me, I think, was the consistency of thought. Didn't matter what the topic was, they applied a consistent thought to every topic. And that, for me, gave it a really solid foundation. Doesn't mean you know the answer to everything, but a solid foundation. Also, through that, you naturally get to the point of thinking about money and what it is. And you naturally then, bear in mind this is now probably 2009, you naturally lead to gold being, why gives gold money? Why has it been like that for 5,000 years, etc.? And then the sort of the benefits of a harder form of money compared to the paper or electronic versions we used to with the pound, the dollar, etc. I then had I think it was probably the normal reaction, getting to that point and understanding how the system works, at least a little bit better, when you think, why is this thing not all fallen down and crashed already? And surely if it hasn't, then it's going to do at any moment. But of course, that's not how the world works. The world doesn't work based on when I find something out, it therefore reacts to it. It doesn't care what I think. And so then that was quite interesting because then I was really, okay, right, so I've got sort of a piece of knowledge here, which is quite interesting and useful. But of course, Austrian economics tells you nothing about timing. And so it was like, okay, well, this could happen tomorrow. We could get another crash tomorrow. We could get, it could be 20 years. Who knows? So I went back to focusing on more my career and then happened across Bitcoin in 2013. And I did what I normally do. This will be a little bit of a theme, which is I dabbled a bit. I wish I dabbled more, obviously, but, benefit of hindsight and all that. So I dabbled a little bit and just to try and say, what is this all about? I didn't really understand it, but I found it interesting and then sort of forgot about it for a while, went back to my career and focused on that. Never thought that the two would come together at any point. We then had the COVID lockdown crash, March 2020, and that meant we were incredibly busy at work. But when that had eased off a little bit, I found myself going back to looking at Bitcoin, looking at all these other alternative coins, and dabbled a bit with, so what is this NFT stuff all about? What does it mean? What is this Ethereum? Dabbled a little bit just to try and understand it. And in that case, I was glad I only dabbled a little bit because by deep diving on those areas, I realized that there is a clear difference between Bitcoin and everything else. And that once I had that realization, which was probably late 2021, again, things become a lot clearer. And it's easier to actually spot things which are haven't got very robust foundations. So then we come around to February 2022. So you'll remember, I'm sure, that's when Russia invaded Ukraine. And it wasn't so much that, it was the event that was an inflection point in my thinking was I think technically they froze the assets rather than confiscated them. I think that happened earlier this year. But they froze the Russian assets such as the US Treasury bonds, EU bonds, UK gilts. I think Japan was also involved. They froze whatever that was, a couple of $100 billion worth. They just froze them. And for me, that was a big turning point. I mean, it's not about whether Russia should or should not have done what they did or whatever. It was more the fact that for 40 years, longer really, the US Treasuries and government bonds from Western governments have been a store of value. And I suspect at the higher levels, all around the world, sovereign wealth funds, etc., they knew that the currency was being debased. But, if you're losing 5 to 10% a year, you can you can get yourself comfortable with that as long as that's not the only thing you've got and you've got a long-term plan for what might happen. And a lot of these sovereign wealth funds, of course, they have gold as well. You could argue that's a bit of a hedge. This was different, though. This was basically going from 100 to 0, not 100 to 95. And just like that. And of course, the threat is that if they can do it once, they can do it again. And if they do it to Russia, they can do it to any other country around the world that they're getting a bit of a fight with. So that was a big. So that it was in February 2022 that I turned around to my investment team and I said, "Okay, I didn't think I'd be having this conversation, but the time has now come to think about how we can use Bitcoin institutionally." And my expectation is that it will take a couple of years to figure out what we're going to do, to help to educate trustees, pension trustees I'm talking about particular here. It's going to take a bit of time because it's not an easy subject for people to get their heads around, but we need to start that journey now. It's now moved from being something which is sort of a retail type of investment, the man on the street, the woman on the street, to now coming into the institutions, or at least we're on that journey. So that was quite a moment. Just trying to bring that round to the free cities. So I can't even remember where I saw it. It could have been on Twitter or something like that. I think it was the first London meetup. And I think that's why then it came to my attention. And so a lot of things, I looked into it and I thought, oh, that sounds interesting. I like the principles involved. It's a shame the UK isn't one of those places that's on the map.
It might be now. No, we can go into that later, but there is a project in the UK.
Oh, okay. Excellent. Good. So that was okay. So I like the concept. It looked like very early days, but going back to the dabbling bit, I thought I'm keen to find out more. I want to dabble a bit in that. And I went to what I think was the first London meetup, and then there was one a month or two later that year. And I would have gone to more, but I think when they've come around, I've just had a clash. But I'd encourage people to, if they like the principles, involved, and obviously they're all on the website, then go, because there's some great people involved.
You're talking of the 2008 crash. Your story goes back to there. The first thing I heard about the 2008 crash, right, was literally The Big Short. When I watched that film, I had no idea it happened, and which just goes to show you that you can live in this world. I was working for the BBC at the time, which, in one sense, was a kind of good idea because it's not funded. It's not like a company that needs to make money; they get funded anyway. But I had no idea stuff like that was going on. Which is, I was kind of adult, male, in touch with what was going on, so I thought, but I had no idea of things like that. And I imagine, correct me if I'm wrong, but working in the business that you work in, you must be relatively unique in the pensions market. You don't get a lot of people thinking about strange things in pensions. Is that right? When I think about, I know a bit about finance now, thank God. But when I think about the spectrum of finance, especially adoption of new things, pensions comes right at the end. Is that right? It's like the slowest moving. It's like the tanker. That really just takes a long time to sort of shift direction. Is that right? That's the reputation at least?
Yeah. Well, I suppose some of that is justified. It's intended to be long term. Isn't it long-term financial planning? For some people, retirement's right here, right now. But for a lot of people, it feels like a long time away, and it's difficult to imagine it actually. But most people try and put something away for long, and so it is slow moving in that sense. Some of the sort of governance structures around pensions can be slow moving as well, and maybe that's a consequence of, if you've got 20 years to make a payment out, then you don't need to be meeting every day now, do you? Once a quarter or once every 6 months is probably more than enough. You don't want to be chopping and changing and what you're doing. It comes back to that long-term planning, but it would be quite helpful, I think, sometimes if pensions was a little bit more nimble. We try and do that, but it would be helpful, because the problem is that whilst you might have a 20-year time horizon before someone retires, the opportunity might be here and it might be quite fleeting, and particularly if they might be to buy or sell something. And particularly if you factor in the Austrian business cycle, and which was the 2008 was a perfect sort of classic description of that. But even then, we had some people, some trustees can be quite quick. So we were buying some equities in March and April 2020 when they'd just gone like this, all the way down 30%, and buying some. And then we never expected it to happen so quickly, to bounce back. But sometimes you get lucky, I suppose. What
did pension funds do to hedge against inflation then? What's the traditional way of hedging against inflation?
So it's to buy, there's slightly more sophisticated ways to do it as well, but essentially it's to buy UK government bonds which have got an explicit link to inflation. So in other words, a bond is where you get a coupon payment every 6 months normally, and then after the end of whatever the term is, could be 5, 10, 50 years, there's a redemption payment. So which is like maybe you get £3 a year for 30 years, and then you get £100 back at the end. Those £3 and the £100 have all got some explicit link to, it tends to be RPI or CPI, so the retail price index or the consumer prices index. So there is some protection that pension schemes can get from that, and the pensions they pay out have got the same sort of link to inflation. So the pensions might go up in line with the retail prices index or up in line with the consumer prices index. So you've got an asset that roughly matches the liability, which is a big part of what pension schemes need to do, because they shouldn't be putting it all on red. Or
is that still a good strategy in 2024? I hear a lot about bonds and 30-year bonds and, I mean, I don't really follow it closely enough, but I know a lot of people have been up in arms about very bad rates on long-term bonds and things like this. So what's the strategy in 2024 then?
So it depends on your position as a pension scheme. So it's probably worth just a step back for a moment to say there's two main types of pension structure, right? So defined benefit, or sometimes known as final salary. So DB, I'll refer to that as, and defined contribution or money purchase, or DC, I'll call that for shorthand. So you've got DB and you've got DC. So DB is where a promise has been made that when someone gets to retirement, they'll get a certain percentage of their salary when they retire. So historically, that was you'd earn your salary throughout your career. Of course, in those days, people spent their whole working life at one company. So you spend like 40 years working for a particular company, and at the end of that time, when you retire at age, let's say 65, you get 2/3 of your salary as a pension. So that's defined benefit, that's DB. DC is where you put in a percentage of your salary. The employer will put in some percentage of your salary as well. Your pension is whatever that pot of money buys when you get to retirement. So two massive levers are, one is how much money is put in over the years. Secondly, what is it invested in? And does the value go up or down? And how much does it go up or down? So there always has to be like a release valve, if you like. Whenever, if you think what could go wrong in both those scenarios. So the DB, what could go wrong is that there's not enough money in the pension scheme, in the pot, to pay your 2/3 of salary, or whatever percentage that each person has got, each worker has got. And that could be because not enough money was put in the pot by the company, or the company's gone bust, and they're just no longer around to pay your pension. So in that case, the release valve is you don't get the pension you're expecting. I think it's quite tough, because I think it tends to be a bit of a cliff edge risk. It's a bit binary. But also I think it's really difficult for the average worker to understand that risk. So I've got a lot of sympathy for the members of those schemes where the company goes bust and they only get half their pension. And
who does pay it when the company goes bust then? Well,
there is a protection fund. There is a government-run the pension protection fund.
For all pensions, or do you have to you put a specific amount in as a pension fund, and people can take it out if you specifically go bust? Or is it just a general fund?
So it's more that. So it's only these DB schemes, and each of those DB schemes pays what, on the face of it, looks a bit like an insurance premium into this pension protection fund. And if the company goes bust and there's not enough money in that DB scheme, of which there are about 5,000 in the UK at the moment, then the pension protection fund will take the assets of the scheme and then pay. It's roughly about 70% of the value of the pension.
And what do pensions do about like things like hyperinflation, or we had probably about 20% inflation during COVID, wasn't it? Year on year. What do you sit around and talk about at the table when you're going, Jesus, like these people are losing 20% of their money every year? You've just got to make better investments or something, or like, there's no way to hedge against that other than, well, there possibly is with Bitcoin, obviously, but what do you talk about in situations like that?
Well, it comes down to the technicality of each scheme. So they don't normally say, we'll give you, £1,000 pension plus inflation, whatever inflation is. There's normally some kind of cap. So it might be 5% a year or something like that. I mean, when these schemes were originally set up, there were no pension increases at all. And then it was various government regulations that came in that said, you've got to give at least this, you've got to give at least this. And there was various levers of persuasion that were pulled to encourage companies to carry on providing those benefits. But that means if inflation is 20% and you got that £1,000 pension Yeah, you next year you might expect it to be 1,200 quid, but it's not. It's 1,050 because of that cap. So there's some protection for the company that's sponsoring that DB scheme. But of course, again, it comes back to that release valve point. So who loses out? The members lost out because they can now buy 15% less food, energy bills, etc., than they could before. So there's always something that gives.
Have you noticed, like me personally, obviously, out in my real life, I've noticed the inflationary increases that we've had recently, quite severely. I mean, and I know a lot of people who feel exactly the same. Earning decent money, doing the right thing, and noticing they're not even coming to the end of the month and it's all gone. And that didn't used to happen at all. There used to be some left over to spend on doing fun things. What's it like in the pension world? Because presumably people on pensions have it even worse, because unless they're out there earning money, they can't go and make more money. They're kind of relying on it, right? So, I mean, do you get feedback, or do you have focus groups, or do you have people who are actually living off your pensions, for example, telling you what's going on?
Yeah, I mean, there'll be member complaints to say, I can't afford what I need to. But I mean, it's very difficult from the trust, because from the pension trustees' point of view, their job is to pay the benefits that have been promised by the trust and treat all members equitably, fairly. So they can't just say, "Oh, okay, Joe Bloggs, you got a point. Here you go. Have some more." Because then you're disadvantaged in other, because they've only got so much money in the trust, you see. So it's very difficult. I mean, and to be fair, those trustees are paying what was promised, and it's all laid out, and everyone knows what those benefits are. So they're not doing anything wrong. In fact, the opposite, they're following the rules. But it is unfortunate that then, because of circumstances, that the pensioners lose out. Now, I suppose your point there is, okay, what happens in hyperinflation? Well, first, hopefully that doesn't happen. First of all, we're not there yet.
That was going to be my next question, but anyway, I'm still going to ask it.
Okay.
Well, you're an actuary, right? Traditionally. So what's the risk of hyperinflation then? I mean, that you should, presumably, this is something you think about or you can calculate, right? Is there a number on that risk?
No, you can't calculate. Because it's from a sort of actuarial technical point of view, you've got your distribution of possible outcomes, and then you've got the tails, which are the really extreme scenarios.
And that's where it lives.
And the tails of the distribution of any kind of outcomes is notoriously difficult to model. In fact, I'll argue that all the modelling is wrong. As a friend of mine used to say, all models are wrong and some are useful. But that means...
Explain that. Why are all models wrong, though?
Because they're an estimate of the real world. So maybe that takes us back to Austrian economics. I mean, if you look at Keynes and that line of thinking, and Milton Friedman to some extent, then they look at the real world, build a model and say, right, I understand how the real world works. So all we need to do is change this parameter and everyone's better off. Or I get the policy outcome that I'm looking for from a government point of view. And the problem there, of course, is that it's not a pure reflection of the real world. The real world is much more complicated, doesn't allow for human behaviour changing, sometimes mixes up inputs and outputs into the model. I mean, it's a mess. So every model is wrong. And I think the actuarial profession as well frequently forgets that all models are wrong. But as I say, they can be useful because they can help to illustrate and to understand certain relationships. But let's not forget.
Do you get actuaries who are Austrian economists? Is it something that you could?
I haven't met many.
But are there companies famous for being a little bit more Austrian, for example?
No, I'm not aware of any of that. And there's no Austrian, as well, at least certainly when I did the exams, there's no Austrian economics in the actuarial exams themselves. They've got Keynes, they've got Friedman, and the world of economics is described as basically a fight between them two, with no other possible thought.
I recall that myself from A level. That's about as far as I ever took it. But it's quite astonishing, isn't it, really, when you think about it? Because I don't know many people who understood Austrian economics and then decided to go back to one of the other models. Do you? I mean, I don't think
I don't know anyone.
No, exactly. No. It's just why do you think that's what the chosen models of economics are then? Why is it that everyone's a Keynesian and taught the Keynesian way, and like Paul Krugman, these kind of people? Why is it Keynes that made it to the top of the pile?
He was a well-connected person at the time, so had a lot of influence, and I think there's something quite for a lot of people quite attractive in thinking I know better than everyone else. I mean, these models effectively claim to help you predict the future. Who doesn't want to do that? I mean, that should be a big red flag as to why they're nonsense, of course. I think as humans we crave certainty, and what Keynes in particular did was he gave people certainty about certain things. I mean, a lot of it was nonsense, but from the bits I've read about, he was a very confident man and could deliver messages very strongly, and so people wanted to believe that. It's much more difficult and, I guess, humbling to realise that that's not how the real world works. The real world is full of human beings, each with their own brain, each with their own decisions, each with their own values. They value everything differently to everyone else, albeit maybe only slightly in some cases, but also there's no way of knowing what they value and how much. And you can ask them, and they can have a bit of a guess, but they only really know is when they, let's say, buy something or sell something. When it results in some kind of activity, doesn't have to be transaction related. It could be how they spend their time. That's the only way you know. But then something else comes along, some other opportunity or choice, and that then means that you don't know how many choices do we have in our lives? Billions, probably. So the idea that could be modelled is so ridiculous that I don't know how anyone believes it.
Sorry, but I was just going to say, I think that if you never had any economics training or any economics instruction, I get the feeling that's the idea you would come to on your own. That because when I worked out what Austrian economics was, I realized that's what I was thinking. Because I don't have any training in it. I don't have no financial training. As I could say, I did A-level economics, and you don't really take it in. I didn't understand economics when I was 18 or 17. It didn't make sense. And in fact, the way they teach it makes even less sense. At least with Austrian economics, you're basically talking about humans and about what decisions they make and why they make them, and how they express their value. And that makes sense because that's what we all do, I think, subconsciously on a day-to-day basis. But
think about it from the examiner's point of view as well. It's much easier to say, set some question on if aggregate supply increases by 2%, what does that mean for the price or whatever it might be. It's much easier to set an exam question on that than it is something to do with anything to do with Austrian economics, where it's about human action.
Well, in fact, thinking about it now, it put me off economics. I've just realised it as you spoke.
A lot of people off
because that's the way they described it all. It was like marginal this, that, and the other, and it's just like God. It was one of those lessons where you had to learn the concepts because they didn't like sometimes when you're taught things that are real, you understand them as someone's explaining it to you. But with economics, it was like I have to write these things down and learn them like a bloody parrot because I don't really understand them. And the reason I don't understand them is because that's not what people are like, So look, let's talk about pensions and Bitcoin then, because once again, another two words that I wouldn't have put together until very, very recently, until I spoke to Glenn, actually, your colleague. But when I spoke to Glenn, Bitcoin was massively in the news. The ETFs had just been sort of given the go ahead, and everyone was like, or about to, it was one or the other. And there was a real excitement around all this stuff. And I think we've chilled a bit since then. If you're a Bitcoiner, the price and the tech and everything is just raging. But if you're an outsider looking in, you've seen the price acting a bit boringly recently, and that obviously puts a lot of people off. So have you, the first thing I thought about would be that, do you ever get any of your clients coming back going, right, you were wrong? When Glenn was telling me we need to put Bitcoin in our fund, it's gone down 5,000 or 10,000 since then. Is that a reality in your business?
No, we haven't. We haven't had that. The state of play at the moment is that we've had a lot of conversations. We have one client that is, maybe a couple of clients that are have made the decision and are about to implement. They'll be the first UK pension scheme. It's a long journey. The points you made earlier about pensions being slow moving, and I made the reference to, that might mean they've got 3 meetings a year, let's say. That means it takes time. And there's regulations around around pensions which slow decisions down as well, which you could argue is a good thing for long-term decisions.
Sure.
So it just takes time. So where we're at, I suppose, is that our position has been very much add a small allocation to Bitcoin, which might be 2 to 5%. Of the assets. And that is small enough, Glenn probably touched on this, I won't go into huge detail, but that's small enough to not really make any difference when you look at your, all this modelling, all the models that are wrong. Remember those?
Yes.
The volatility of the portfolio and all that kind of stuff, and the risk of the portfolio. It doesn't make much difference to that, but it makes a big difference to increase the expected return from the portfolio. So it's a good trade-off. You want more return without any extra risk if you can get it, and that's in short pretty much what it does.
So, and when they push the button on those trades, what do? Go to Coinbase and buy it, or go OTC? What? How does that work? No. So, and I think this is. Oh, it's an ETF, right?
Oh no, it's not. It's better than an ETF. So there's I'm sure Glenn would have touched on this, but it's essentially, we're talking about institutions here, right? So we need to apply institutional requirements to any investment. So if you are buying some equities, you're not just buying them willy-nilly on your local stockbroker platform. You've got a well-known investment manager who's an expert in that area. You've chosen them because they've got all the right processes in place, the right financial conduct authority registrations, all those kind of things. And then you've got a serious process to actually transfer the money across to them and keep it all monitored. We need to apply the same principles to Bitcoin. And so it takes a bit of translation because Bitcoin is quite a different asset, but it means that, it's quite interesting actually going through the operational due diligence process, because I realised about halfway through that we were going into a lot more depth than we were on any other asset. any other asset class. And if we applied the same principles to every other asset class, yeah, I think most of them would be fine. But actually, some might look a little bit iffy. So you're going to extra degrees with Bitcoin. But the reason for that is because if you buy an equity fund, you're not just looking at the security of the asset. You're looking at, well, how are they choosing which equities to buy? When are they going to buy them? When are they going to sell them? And all this kind of, what's their worldview? What's their philosophy for buying certain types? So you go into a lot more detail in that. Instead, we've taken the same amount of time on the research, but focused all on the custody of the asset. So it means you deep dive. So you end up with, what's the safest way to hold it from an institutional point of view? Well, multi-signature, which certainly in Bitcoin circles is standard terminology, multi-sig. But you want them with different institutions. You want them in different countries, ideally, as well. And then you want a solid process for making sure that no one can move that Bitcoin unless it's been instructed by the trustees of the scheme, the pension scheme.
And you had to come up with all this yourselves? Yeah, like the first... Are there any other companies in the UK doing this?
I don't believe anyone else is doing it at the moment.
Wow.
In fact, I mean, some of them may say, hey, we don't understand Bitcoin, but yeah, why not? Let's just copy this, copy Cartwright. They might say that.
Can they, though? How would they know what your process is?
Well, I mean...
people on the inside.
Yeah, well, there'd be... I mean, I guess you could, if you investigated, you could probably work out what we're doing and all that kind of stuff. But the problem in our industry, in the pensions industry in the UK, is that, well, there essentially is no... I mean, I don't want to tie everyone with the same brush. That's not right. But by and large, there seems to be no real understanding of what money is.
That's a bit of a mic drop. I think that's fair across the whole of society. I didn't until relatively recent, and I'm probably only 5% down the rabbit hole, but it's already blown my mind 100 times.
But this is part of their jobs. So they are investing billions and billions of pounds across multiple pension schemes and talking about equities and bonds and seemingly never once questioning the unit of account. I mean, it's a good angle to pull the thread on, because then it leads us to some other thoughts about how the pension system in the UK could be improved.
But when you go to say an institutional pension or something, like a corporate pension, right? You don't talk to them about what is money, do you? Do you have to come in at that level, or do you just say, look, here's an asset that's performed whatever 100% year on year, whatever it is? Why don't you buy it?
So, I mean, the short answer is no. Yes, we do have to come in at the what is money level.
Really?
And those training sessions have gone down an absolute storm.
I 100% believe you, because I think nobody asks that question except the odd, Bitcoiners are renowned for doing it. But other than that, I could guarantee you anyone, if I walked outside this door, who I asked about money wouldn't have an answer, just like I didn't used to have an answer. I'd never thought of it. Thought about a few coins in my pocket and some paper. And even the guys that work in finance, they're very myopic about it, aren't they? If they're dealing in bonds or stuff, they're just in this part of the spectrum. They don't wonder what's, secondary order effects. It's incredible.
And some of that is justified, because if you've got a trader or fund manager, and then their job is to buy the right equities or to trade the right bonds at a particular time. It's a very specialist. You probably don't have time to think about it, and to give these sort of pension trustees a bit of a let off. They've got a lot of things to be thinking about as a pension trustee. It's not all about where the assets are. So, to be fair, they probably think they've got their hands full, and that's fine. And I think in a lot of cases, it's been fine. But the problem now is it's been fine for the last 40 years. Right? The problem with it now is that whenever there's an inflection point, a step change, that's when I think it's always a good time to go back to first principles and say, okay, are we going in the right direction? Are we designing the right things? Are we creating the right solutions? You can't assume that the solution we've already got that's worked fairly well for 40 years, why would that continue to be the same? And so so the inflection point we've got is, I suppose there's multiple inflection points coming together. So we've got a move from, we've got about 1.2 trillion pounds worth of DB scheme assets, roughly, in the UK. We've got a bit less than that in the DC, which is it's one where money goes in a pot, you get whatever comes out at the end. So there's a bit of so the inflection point there is, okay, the DC assets are going to be larger than the DB assets. Sort of related to that is you're going to start to get people retiring on this DC rather than predominantly DC rather than predominantly DB. And in a lot of cases, they'll realise, oh my goodness, I haven't got anywhere near enough money to retire. So that has various social consequences, and people not wanting to retire late, and what does that mean in terms of the work pool, etc. So there's lots of other social consequences there.
And this is as a result of inflation mainly, or
it's mainly to do with not putting enough money in the first place.
Why weren't people putting enough money in? Are you talking about individuals or the
both
funds?
I'm talking about both individuals and the companies that they work for. So there was a for various reasons, defined benefit schemes got more and more expensive, and part of that was to do with interest rates coming down and down and down and down over 40 years. Part of that was to do with the government ramping up the benefits that needed to be provided through these DB schemes. Part of it was the government ramping up the regulatory burden and the stuff that trustees and companies had to do in relation to these schemes. So these schemes became less and less attractive and more expensive. And so it reached a point, and it was different for different schemes and companies, but over the last probably 10 to 15 years in particular, where the company said, that's it. I can't afford this anymore. The cost is is ballooning, and it looks like it's only going to get bigger. I've got to stem the flow from a financial, otherwise the company may not be sustainable. And so they basically closed the DB scheme and moved everyone over to DC. But of course, there were two main reasons for them doing that. One was, we can't afford the cost, we need to make things cheaper. And so the consequence of that is that less money goes in because they're trying to save costs. The other is, the risk is too big, we need to make the risk smaller. Well, that's done anyway by moving from DB to DC, although you've still got the legacy. So I suppose, so it leads us to where we are. Well, that's why they haven't put enough money in, because it was seen as a cost-cutting exercise. But then the chickens are starting to come home to roost.
Like in real terms, what does that mean for the kind of economy? Like, is that one of those things that people say, in 5 years' time, the shit's really going to hit the fan, or something like that? Is that one of those things?
Yeah, it's. I mean, there are. So I think there's lots of consequences. So people are. I mean, the reality is people are going to be poorer than they thought they were going to be, and that's never a good thing.
Especially not old people.
Especially old people who are fast running out of options, particularly if their health is deteriorating. So it's a big problem. I mean, one of the other inflection points was to do with, when was it? Maybe 2016? George Osborne came out and said, that sounds too late. Must have been earlier. But anyway, came out and said, it used to be standard for when you had a DC pot. When you got to retirement, you could take some of it as cash and the rest you had to buy an annuity. You had to go to an insurer and buy an insurance policy that then paid you a pension for the rest of your life with whatever that pot would buy you as a pension. That was, it's good in some ways because then you're passing the risk of living too long over to an insurer, and you know you're going to get that, whatever it is, £1,000 a year from the insurer. The downside is that it was generally seen as a very expensive way to do it, but the primary reason for it being expensive was because interest rates had come down like this. So it was all a bit artificial, and of course, gilt's crisis in 22, and the gilt yield shot up again. So that George Osborne did away with that requirement to buy an annuity. So then you've got a situation where people who get to retirement, they don't buy any insurance. They just say, right, I'm going to take a percentage of my assets, 5% of my assets every year as a pension, and hope the rest of the pot lasts for long enough to last me until I die. And hopefully there'll be some left over and cover my spouse's living expenses, etc. So it's a much more uncertain world that we live in. And if you combine that uncertainty that the man on the street has with the pension being low in the first place, it's not a pretty place. And that is only now really starting to come through because of the timing of when people retire.
And the result would be poor older people. I mean, what do they do in that situation? Claim off the government? Try and get a...
Well, there'd be a state pension.
Yeah.
There was used to be a winter fuel allowance.
They can sell property as well. There's a number. Older people tend to have property, don't they?
That's right. So maybe they could downsize their property. There's things called equity release mortgages,
That's
which
right,
obviously is a whole category.
Has that started happening then?
Oh, yeah. As far as I can tell, yeah, it has, yeah.
But the price of houses is coming down, is it? Because that would... I mean, there's not a lot of people to buy older people's houses, are they? That's the problem. I mean, older people... My next door neighbour just had the same problem. They were trying to sell their house. It was like £800,000, whatever, and there was no one to buy it because the mortgage was $5,000 a month if you want to borrow the money, which obviously, who can pay $5,000 a month on a mortgage? I mean, some people can, but not in that house. But is that true? Like, it's hard. There aren't that many buyers of large sort of older people's houses because of interest rates currently.
Yeah, I mean, I don't know that. I've only got a rough impression of what's going on in that market, but it wouldn't surprise me. So if we've got, I mean, these things change quite a lot, but latest I saw, I thought that house prices were roughly flatlining. So when we think about the money, that means they're going down in value, doesn't it, in real terms?
Yes.
So maybe you've got two things going in different directions. So on the one hand, you've got the money falling in value. So 800 grand is not worth 800 grand the next year. But in the other direction, you've got less demand for those properties. And there's obviously a lot of talk in the press about the young not being able to afford houses or any property. And of course, if that cuts off the bottom rungs of the ladder, then the top rungs are going to suffer as well. So, yeah, I mean, maybe they're all realising that there's too much monetary premium in the house and they all want to buy Bitcoin instead.
Well, if you ask the question, what is money? One of the answers is houses. People are using houses as money. They have been for a while now. They're not a good form of money, but they're better than like notes and coins money.
Yeah.
And that's the problem we find ourselves in is, I'm fascinated that you actually get to talk to people at, corporate funds and things like that about what is money. Do you find them pretty financially illiterate then in these kind of industries?
I mean, no, very smart. I mean, we're talking very smart people.
Just not on that question.
But it's just they've never asked that particular question. You can, so it's not a criticism. I could blame myself for being in the same position a few years back. Just my mind wandered a little bit, and I found myself asking that question. If you grow up through, the normal routes to get to be a finance professional of some sort, the exams you've done, the experience you've had, none of it asks what is money. So it's not a surprise. So it's not a criticism in that way. Otherwise, I'd also be criticising myself. But then that's why it's such an interesting question to ask now, because it's, oh yeah, that's interesting. Let's talk more about that. There is a nervousness. So Bitcoin is a grassroots movement, and I like that about it. I think, something that favours the man on the street first, I think is actually very healthy for society. But then the same thing sort of plays out when we talk to these groups of trustees. So they will, on an individual level, say that's really interesting. And maybe to one side they'll say, where can we get some? But with their trustee hat back on, they're nervous. They're nervous because then they're taking a decision on behalf of someone else. And they shouldn't be, because we'll hold their hand for starters, but also they should just be treating it like every other asset. The reality is bonds are incredibly complex. Equities are incredibly complex, yet pretty much all pension schemes have some of both of those. Property is not straightforward when you get into the detail. A lot of pension schemes have some. But what happens is you're building a strategy. You're saying, okay, these are the characteristics for that asset. These are the characteristics for that asset. We're going to put them together. If this one over here is super volatile, let's say it's a Tesla stock or something. Yeah, I want to have a bit because I want to diversify, but I don't want loads of it. So I'll just size the allocation accordingly. And just do that. That's all we're saying. It's saying this is a legitimate asset for institutions. Just buy a little bit.
Presumably, though, they know about the ETF and about BlackRock and about all this kind of stuff. I get the feeling that it doesn't really need legitimizing anymore. Like, why wouldn't a pension fund or any kind of fund really just put a small amount in there? Just hassle? Or,
yeah. Well, so there's some that definitely shouldn't. So it doesn't apply across the board, but they're fairly easy to identify. So a lot of these DB schemes, the way out of the situation is if it's affordable, they can pass the whole lot over to an insurer, right? And that is a good thing. Right? That is in the world in which we live, that is the maximum security you can get for those members' pensions. So if it's affordable, you've got to have a really good reason not to do it. So if let's say you expect 2-3 years until you get to that position, why would you buy a volatile asset that, for a long, so but you've got a longer time horizon, 5, 7, 10 plus years, then it should come into the conversation. And then, I agree with you. I think they should be seriously considering it. I think one of the things that's held pension trustees back, and maybe the same applies to charity trustees as well, is because of all the misinformation around the environmental and social disadvantages of Bitcoin, or the bad effects of Bitcoin on those two areas. As we know, that's nonsense.
Well, we also know that BlackRock changed their tone literally overnight. Yeah. And lo and behold, they released an ETF a number of months later as well, which just shows you what a load of nonsense it is. It really. Yeah. But you're right. We also know that it's actual nonsense as well.
Yeah, exactly. So you could argue that BlackRock, they had something to market before, they got something to market now. That's what drives what they say in public. That's up to them, what they say. We don't know whether they actually believe it or not. But from a trustee point of view, you need to make sure you know what you believe and what you don't believe, and base that on proper information, reliable information.
So what's your proof then to a pension fund that Bitcoin's environmentally friendly then, which is like, what is it? Data, examples of the fact that other companies are buying it, therefore, is that the main thing? Or do you actually have to supply them with data? Look, this is what actually happens. This is where the energy goes. This is how much energy it uses. This is why you've got to start thinking, you've actually got to ask the question, what is energy as well?
Well, that's right. So it probably, I mean, and obviously each person's going to react differently to different things, aren't they? But it probably starts pretty much with, and it bleeds into the social aspect of as well, is using energy is good. Now, a lot of people struggle with that.
Yeah, very much. A lot of people.
But, you look at a chart of, GDP per capita and the energy used, there's a very, very clear correlation. Of course, correlation isn't always causation, but in this particular case, it's pretty clear that it is. So if you, I went to Africa last year, actually. That was fascinating, about a year ago. Went on a charity thing to Tanzania. We're building a school classroom. Well, I was just trying to help. I mean, I wasn't in charge of it, thankfully, but that was great fun. But one of the reasons I did it was because I was interested in what is the world like outside of the bubble that we're in over here. And I took my son as well because I thought he needed to know that we're probably living in a bit of a bubble. That's teenagers for you. So it was very clear from that, along with lots of other things which were really fascinating, that it does not take much energy to massively improve their standard of living. And it's coming back to the trustee, and also it's much, you can't just give them a windmill, or a wind turbine. That's not going to work. They need motorbikes. They need one of the fun things that I got used to spotting was the number of lots of motorbikes around, because it's a cheap form of transport, and I liked it for two reasons. So one was it showed economic activity, and secondly, they were pushing the motorbikes to the limit. They would pile them up so that they were as big as a car. And it would be all kinds of ridiculous things. Even one guy was carrying a pane of glass in front of him like this, which didn't look particularly safe. But it just drove home to me that energy is if you care at all about any of these, people in the world who are worse off than we are lucky to be in the UK, they need energy, and it doesn't take much to make a huge, huge difference. So that's the first. That was a slight tangent, but that was the first thing. That's probably the first thing to get over in terms of this ESG or environmental social governance type discussion. Energy is good. Now, it's not using energy does not then mean we fill the air with smog. You don't have to. One does not follow from the other. There are cleaner ways of doing things and dirtier ways of doing things, just like there are in any industry. And we all want clean air, clean rivers, or at least we should do, and to look after the local environment around us. And Bitcoin can help with that. So we talk about, some people need data, some people need narratives and stories, don't they, to be able to picture it, to imagine it. We talk about stranded energy, could be hydroelectric dams or biogas, and it's just being wasted, or unreliable energy from the sun and the wind. It's great when it's sunny and windy and it's flowing into the electricity grid, and that's all brilliant. But if everyone's asleep, then at the moment, as far as I can tell, the energy just basically just gets sent into the ground and it's destroyed. Well, there's ways around, you plug a Bitcoin miner in, there's ways to actually improve that situation for everyone across the grid and essentially subsidize that grid whilst using that clean energy. So there's lots of things that could be done. And the only reason that Bitcoin is so good for the environment is because it uses energy. That's not the case for the other, essentially virtually all of the other coins.
It's quite hard to get your head around, though, I'm sure.
It is. It's because it's it's like a lot of things in Bitcoin. You need to take what you knew or thought you knew, you need to turn it upside down and shake it a lot, and then look at it again with a fresh pair of eyes. And maybe what you thought before was correct, maybe it wasn't. But it forces you to think about things differently. You
mentioned Africa. One of the things I love about some of the Bitcoin projects in Africa are that Bitcoin mining is a way to bring electricity to those places.
Yeah.
And it's an astonishing, I love all these second order effects. You go to the village you were at where you're building a school. If they can get their hands on a miner, which can easily be donated, and they've got a source of free energy there, which they almost certainly have. They're probably next to a river or a stream.
Yeah.
Start producing Bitcoin for free, basically, other than the cost of the machine, which almost certainly someone would donate. It's quite a common thing. And before you know it, you're bringing in a revenue to start electrifying your town.
You get a mini grid going.
Yes.
Yeah. I mean, and that's, again, it's like little things. So the fact you've got the ability to turn a light on at night, the fact that you've got the ability to cook on electricity rather than a wood stove, which can be extremely unhealthy, particularly it's indoors. I mean, these are things we completely take for granted.
So you would say you've got two people about to push the button, or two pension funds about to push the button. Are you hopeful that this is going to become a common thing? I mean, like, how is Cartwright's viewed in the general industry that you work in? Are you the kind of like batshit crazy guys that are trying to get everyone to buy Bitcoin? Or like what? I mean, it's a very conservative world. I've got to imagine that. I think of insurance and pensions, and I think of very straight down the line people just doing their job, maybe accountants as well, just like doing a thing, not taking too many risks, Like, are you well received in your profession?
I mean, I believe so. I mean, maybe they're all talking behind my back about being batshit crazy, but we're not doing this lightly. And, there's loads of people that you speak to that take Bitcoin and the way it operates and what it does very seriously for good reason. We don't believe it's a fly-by-night. We do proper institutional analysis around it. We'll help the trustees say, okay, if you put 2% in, this is what the upside could be. But let's take the worst case scenario. Let's say it goes to zero overnight. So you buy it, immediately goes to zero. What does that mean for your overall objectives? Okay, you're expecting to be able to insure the scheme. You remember me saying that you pass it over to an insurer eventually. You're expecting to do that in 10 years' time. If you buy 2% of Bitcoin now and it falls to zero, it takes 10 years, 3 months. So let's look at this from a cold, calculated risk return perspective. This is a good bet. You've got equities, you've got other things. Why would this not be a sensible thing to do as part of a portfolio?
Who did you have to convince to do this in your chain of command? Is it just you, or did you have to go and sit down with some people and say, look, I want to get some people to buy Bitcoin, which I must imagine would be quite an interesting conversation to be had.
Yeah. Well, my boss is the owner of the firm, the majority owner of the firm. So I had to convince him I'm not batshit crazy.
You're mates with him, I take it.
Well, yes,
it's not like you went into some big office and sat down the end of a long table and went, I've got this great idea for the company,
I mean, he might have thought I was a bit batshit crazy to start with, but we talked about it, and whether he fully gets it or not, I don't know. But I think he's can see the upside from a business point of view that it's worth talking about.
Is that a lot of responsibility to bear on your shoulders?
Yeah. I mean,
do you wake up sometimes and go, oh shit, if this goes wrong? I mean, because I've been a Bitcoiner for years, and there's still a non-zero chance of it going to zero.
Yeah.
You know what I mean? Like, I still think anything could happen, even though I'm fully on board and I'm fully into everything about it. And, I mean, does it, or is that part of being an actuary anyway? You just get used to risk.
I
Because you're trying
I
to
think
mitigate it mainly, aren't you?
Yeah. I mean, I think you want to make defendable decisions, but if defendable decisions mean you hide under your bed, then something's gone very, very wrong in the other direction.
You're right.
So we're a firm that likes to test out new ideas and, think of things outside the box. I think that's a healthy thing, particularly when we've got all these inflection points going on at the moment, whether it's in the pensions market or financial markets or what have you. So I would see it the other way around. I would see it as less risky. I speak to people from other firms, for example, maybe they're looking for a job. And I've had people say, they're one of the big firms in our industry, and they'll say, "Oh, it's not the time to move yet. It's too risky to leave a big firm." And I'd see things completely the opposite. I think if you're a big firm, you tend to be not very nimble. You got access. There's some advantage in terms of economies of scale, possibly, but actually you do get diseconomies of scale eventually. Whereas a small firm, you can be much more nimble. You can say, right, you can have a right, we need to do this now. Let's just do it. And that to me feels less risky, and therefore I'd probably struggle to sleep at night if I worked at one of the big firms.
Well, that's what they say about Bitcoin, isn't it?
Yeah.
You shouldn't be short Bitcoin. Quick question. We're going to have to wrap it up soon. Unfortunately, we've got a time limit on this room. A concept that I've come across recently, which is something I'd never thought about before, is, and I've got one friend in particular who's always telling me to long volatility, long vol. I've always thought of volatility as being a bad thing.
Okay.
Well, it's true. This is my sort of normal person, man in the street brain. I want, like you were saying, you want to know what's going to happen. You want some predictability and all this kind of stuff. But through being a Bitcoiner, I was introduced to this idea that actually, you can make your life, you can base your decisions around volatility, and therefore you actually create this very robust strategy for yourself. You know what I'm talking about, right? Can you go into it? Because I'm still learning about that kind of stuff.
So I'm not sure I'm entirely with you, but let me guess. So,
Bitcoin's long volatility, for example, because you are basically creating a hedge against. You're making something out of the volatility instead of
you're
losing
embracing it, aren't you?
You're embracing the volatility. Yeah.
So as long as you embrace it and think in advance about what you would do in certain scenarios, volatility is nothing to be scared of. In fact, it might give some pretty fantastic opportunities if you understand the asset in which you own or want to own. And it is obviously much more volatile than equities, for example. So it does put some people off, but it comes back to, in a portfolio, constructing a portfolio, it's about, okay, you've got something that's super volatile over here. If the numbers are overall mean it's too volatile, then just reduce the size of it. It doesn't mean zero. In fact, you could argue zero is more risky than not having something. It's just, what is that zero? So actually, you asked me earlier what the probability of hyperinflation, and I gave you 2/3 of an answer. But the answer is it's non-zero. So we've no idea what it is or when it could happen. But it's a non-zero probability because of the way that the financial system is designed. Because what it relies upon is confidence from human beings for it to be stable. And that's probably fine for long periods of time, and has been obviously for long periods of time. But if there's some reason why that confidence disappears, that's exponential reaction. You can't, more so, it's something you can't control. It's probably what central banks are most scared of, is that loss in confidence, which is why they always come out and say these rather.
Your money's safe.
Yeah, which was that make you think as soon as they...
Yeah,
why are you saying
opposite.
that? Why are you saying that?
It's literally the opposite.
Yeah.
Are you allowed to have personal opinions on things? Like, for example, like what is your personal opinion on the likelihood of hyperinflation, say, in the dollar, say?
I mean, on a long enough time horizon, it's 100%, isn't it?
Yeah.
I mean, I may be dead by the time that it happens.
But what about it as the reserve currency of the world hyperinflating? So we're talking about the whole world hyperinflating. What's the chance of that happening?
I mean, I'm not going to give you a percentage, obviously, because that would be nonsense. But there is again. So it's non-zero, and I guess it's difficult. So there's so many moving parts in that. Now, those moving parts could offset each other to some extent. So, for example, it might be that, and of course, we frequently have hyperinflations from time to time, don't we? You know, Venezuela and Zimbabwe and so on. You know, it happens, and what happens? Well, they historically, at least the last 50 years or so, they've tended to then adopt the dollar, the US dollar. So the fragility at the edges, as it were, of the current system has tended to strengthen the centre, being the US dollar and the reserve currency of the world. There are various scenarios, of course, where that could continue to happen, where the edges continue to deteriorate and it enables the US dollar to strengthen further and further, which then, of course, could give the Fed the excuse to print more to try and offset that. Of course, that has so many terrible knock-on consequences. But there are scenarios where the reserve currency goes first. Because, I mean, so for example, if you've, so, okay, there's one example, which I'm not saying, I'm going to say is non-zero, but it's small probability. But if the US suddenly decides to go to war with China, I don't know what they would decide to do from a financial point of view, but they hold whatever it is, $800 billion worth of treasury bonds.
Who, China does?
China, yeah. There's obviously other similar countries that hold some as well. If they were really, really annoyed, they might have said the only way to tell the US to back off is to just flog the lot, just sell it now. So they have to sell the treasury bonds. The immediate effect of that would be that the dollar would strengthen because you sell a treasury bond, you're buying US dollars, and then sell the US dollars to get out of that system. That would probably result in, create a huge amount of instability, but may well trigger some kind of hyperinflation, depending on what other countries did as well who are in a similar sort of position. It's quite a big... There's obviously things that could be done. So, for example, they could start to sell the $800 billion worth, and then the Fed just says, okay, you know what we did to Russia? Okay, you don't actually own those anymore, so you can't sell them. We now own them. Okay, well then that sort of nips in the bud, doesn't it? And so it's understandable why China has been gradually selling. I mean, I think it's since about 2014 they've been gradually selling and selling their treasury bonds and buying more gold. This is all then speculation, isn't it? But it gets quite interesting in playing off different scenarios, which are like models, right? So they're all wrong, but sometimes useful. I could see a scenario where China, Russia, maybe some countries in the Gulf, they gradually get rid of their treasury bond. They just buy more and more gold. And then they say to the US, we're right now, we don't need you anymore. We've got our gold. And the US turns around and says, doesn't matter, we've got 3 million bitcoins. What are you going to do about it? And it's a better money. And then they would end up in a scenario there where, I can't remember if it's all technically correct or the exact timing of it, but the China and India, I believe, for quite a long time were on the silver standard. And Western Europe and the US were on the gold standard. Now, of course, as we know, without going into a huge amount of detail, gold is a better form of money than silver. But China and India stuck to the silver standard for way longer than they should have done. And they lost out tremendously because the harder money won, and the Western Europeans and US were able to buy lots of stuff from China and India, and then eventually they switched to the gold standard. And that seems to be why, China, if you look at who buys gold, the Chinese people, the Indian people buy a lot of gold because they saw what happened in the past, and there's a sentimentality there. It's like a form of storing their wealth. But they might end up falling into the same problem that they did whenever it was 100 years or 150 years ago with the silver and gold standard, and now it's the gold. They think, brilliant, we're on the win side because we've got the gold standard. And then we've now got the Bitcoin standard, and they lose that again. I mean, that'd be absolutely gutting for them.
I don't think... if I would make an educated guess that China is definitely stockpiling Bitcoin through mining.
Yeah.
Because when China banned Bitcoin and there was that big sort of exodus of miners, apparently there's more mining going on in China now than there was even back then. And that's because it's quite easy to work out when mining's happening, but yeah.
Well, I hope for their sake they are, because that'll then give them some protection depending on what happens in the future.
Well, it is an interesting thought experiment. I mean, once again, I'm a Bitcoiner to the core, but I still doubt that a Bitcoin standard will ever arise. I know the theories, hardest money always wins out, blah, blah, blah. But the difference in this case is the hardest money is also defunding the most powerful states in the world, and I know the game theory is, well, hopefully they're buying it then. But we know quite a lot about the distribution of Bitcoin, and most of it is in the hands of who knows who, because it was all distributed early on in the sort of in the adoption curve, and a lot of individuals, as far as I can tell.
Yeah.
So,
probably, yeah. Can
I ask a quick question? Just my last question here. Do your institutional clients care about the unconfiscatability of Bitcoin? Is that an issue? Because you were talking, when you were mentioning how you got into Bitcoin, you were talking about the fact that, treasury bonds are getting seized left, right and centre by America, or So do they care about things like that, or is it purely a financial decision?
So pension schemes indirectly should matter to them, because it's being unconfiscatable is part of what makes it a good money, and so that's then what gives it helps, among other things, its store of value, which is what you're relying on from the point of view of sticking an asset there over in the corner that's super volatile, but you expect to do well. All it needs to do is survive. And it should do very well. I think there are interesting angles when you move outside of pension schemes. So, for example, to charities, and let's take a typical charity. So they've got some assets. They've obviously got different objectives, but you could sort of think of it in the same way. Maybe a store of value. They want to preserve the value of those assets, so they've got some money spent on whatever their mission is. But then there's extra bits because of their nature of being a charity. So one is, how do they get donations in? Well, yeah, okay, they'll probably accept any kind of money, but having Bitcoin as one of the options would seem to make a lot of sense. We know generous Bitcoiners tend to be. And also the money going out the other side. So where's it going to go? How do you get it to where it needs to be as quickly and efficiently as possible? And Bitcoin is great at doing that, particularly if you do micropayments over the Lightning Network, etc. But then that also helps. Not being confiscatable is part of that, getting it to where it's needed. If you need to get it into deepest, darkest Africa for whatever reason, or to Latin America, there's some kind of earthquake or hurricane or so whatever it is, some kind of natural disaster, and you want to get money there very quickly. You don't want it held up at the border with paperwork. You just want to get it straight into where it needs to be. So I think it becomes important there.
I never thought about it like that before. No, I mean, I just wondered whether your average sort of someone who's in charge of a UK pension fund, for example, do they wonder about things like that? Or do they just think, okay, here's the upside, here's the risk? It's looked at on those terms rather than
at face value? Yes, yeah, it's looked at on, and I hope they would think about some of these other things, because I think they are important, particularly because a lot of pension trustees talk a lot about the environmental and the social factors and how they're investing, and it's a shame they've got Bitcoin upside down when it comes to those factors. We're actually showing, the film Dirty Coin.
Yes.
We're showing that. So this might come out at a similar sort of time. So we're showing that to try and turn that narrative around to show, well, actually things are not as they always seem, and they should be thinking about. I mean, there's huge benefits on environmental and social in particular, and nothing else. There's a lot of trustees that say that are keen on those topics, and they're right to be keen on those topics. Here's a tool that can really help. And also, you've got a lot of potential upside, which can help you from a financial point of view in paying members' benefits. It's a win-win on both sides. Why are you not already doing it?
Exactly. I think it comes down to education, because the social aspect of the ESG in Bitcoin is not at all understood by anyone. And in fact, that side of I have a number of friends who work in the environmental world, and they all stopped at Bitcoin is bad for the environment when they heard it first, because it's so easy. That's such an easy narrative to push. And it uses energy. It's like, it's a funny concept. I mean, I'm the same. It's like, I would say the same thing. That makes sense. It uses energy. It doesn't really do much because I don't understand what money is.
It's got no value. It's got no use.
Why do we need to use energy to do that thing? And unfortunately, it's such a big question as the what is money, and why is money important, and why is decentralized money even more important, and why is money out of the hands of an issuer or the state? Why is that important? There are all these aspects that took me years to really wrap my head around. I can understand that people decide not to touch them, because it's like, who wants to put in the effort to learn that, when actually all you've got to do is you're in charge of making sure everyone gets paid their pension. Don't talk to me about, the environment too much, please. Let's just get the pensions made. Anyway, sorry, I'm babbling on. I noticed you've got a lot of notes on your page there. Am I missing some stuff here that you wanted to talk about?
We should have another chat.
Really? Like, where did we not go? I'm amazed. You've got like flow charts.
Well,
and everything.
I was trying to think of something interesting to say to you. So, we covered quite a lot. That's on the first page.
There's more.
The other stuff was to do with what the future looks like in terms of the pensions system. What could it look like? It was also...
Hold on a sec.
Yeah, sorry.
I mean, the only reason I'm saying we can't do it is because I think we're supposed to be out of here at 5. But we can just wait until they knock on the door if you want.
Oh, yeah, it's fine.
Come on, let's go for it then.
Okay, all right. So I've talked about... So I've talked about DB and I've talked about DC. And because of the training, we've also talked about the rather narrow thinking because of the historic training that people have had to be an actuary or whatever it might be. Therefore, when they're thinking about DB doesn't quite work, DC doesn't quite work, what can we do instead? The answer seems to be, let's just try and do a bit of both. And there's different ways of doing a bit of both. But the problem I have with that is, maybe there's some short-term answers there that are helpful, but it doesn't go back to first principles and think about what we actually need to have a robust pension system. And if I take it back to first principles, then I'm thinking, okay, there are 3 things that we can do with money. with our money. So we earn a salary. What do? Well, we could spend some of it, we could save some of it, we could invest some of it. And I'm breaking it up like that on purpose. So spending is obviously easy. You need to eat, you need to live somewhere, etc. You need to buy some frivolous rubbish, possibly. And the savings one it's essentially, historically would have been gold, of course, but now is some combination of, it could be a savings account or a bank, or gold or Bitcoin would be in that bucket for me. And then you've got investment. And the reason why it's in that savings bucket is because then if you hold it in a way, there's no counterparty risk. So maybe it's not cash in the bank, it's cash in your wallet. And then investments is where you are taking on some element of counterparty risk. So you're relying on someone else. It doesn't mean it's a bad idea. I mean, for example, it could be invested in equities, and you are then helping to fund a project and hopefully what is in a profitable company, etc. And you expect returns back over a period of time. There could be lots of other different types of investment. So the problem that we've had over the past, it's probably longer than 50 years, but that's the key bit, is that the only savings vehicle has really been, in this country, pounds, whatever the local currency is. And it's a rubbish savings because of, obviously, it'll be deteriorating, whatever it is, 5 to 10% a year. So, on purpose or not, what's effectively happened, I think, is that people say, well, there's no point in putting anything in the savings bucket. Or I might have a little bit if my boiler breaks down, but I'm not going to put anything in there if I can help it. I'm going to move it either to the spending stuff, so that's when you're buying frivolous stuff that you don't really need because, might as well. Or you move it to the investment, a bit of both normally. The trouble with the investment one is actually it's really complicated. Very few people understand equities, very few people understand bonds, property, etc. So they are therefore either buying stuff they don't need, or they're buying stuff they don't understand. Not a great position to be in. And also they're very limited in terms of savings. So it is tough if something goes wrong. So, but it's for a good reason. It's because the vehicle has not been very good. Now, if we look at how that could then change over time, now we've got better option in Bitcoin. That then sits very neatly within the savings bucket. Now, it's sort of, at the moment, because of its volatility, it sort of sits in between the savings and the investment bucket in a way, I suppose. But as long as you've got plenty of years to go until you need it, then you should be all right. So normally some element of pounds and Bitcoin in that savings bucket, I guess, could work for most people. Most people shouldn't be investing in anything, frankly, because they've no idea what it is. When the Financial Conduct Authority always talks about, I think, how if you don't understand something, you shouldn't invest in it. Well, why is everyone buying bonds and equities then when they don't understand them? It doesn't make any sense. Pensions is a nice cuddly wrapper, but it's just a tax wrapper, and then you look through that, and then you've got equities and bonds. So it's the same thing. It's just a different a tax wrapper. So taking that then forwards now, and I'm taking that forwards 30 years, let's say. It depends on how much you believe in the gradually then suddenly thesis. So maybe it'll be sooner than that. But let's say 30 years' time, what could the world look like? Most people shouldn't be investing anything. And if they do, it'll probably just be maybe a bit of equities. Bonds probably won't have much of a role, because if at that point, I'm saying 30 years, because maybe that's a period of time over which Bitcoin is monetized, and therefore a lot of its volatility disappears, and it's just like a reflection of economic growth. So you expect, maybe it increases by 5% a year or something, which will feel quite tame compared to what we're used to. So for most people, that's a perfect savings vehicle. And they don't need anything else. And if you've got that, then you don't need a bond. So, because you don't have the counterparty risk that you have with a bond. So most people, you probably just have that Bitcoin in their savings, some equities possibly because of the tax wrappers complicate things. And they probably spend a lot less because they've got somewhere to store the value. So there's obviously this stuff they may still want and need, but the frivolous stuff, hopefully they decide that they don't need that. And that would be great, because actually that would then supercharge our economic growth, because that then money would then be available for investment in the economy in some ways, obviously some simple and complex ways for it to get there, but so that should supercharge our growth, which means maybe that 5% a year economic growth is too low, and maybe it'd actually be higher, because we've got lots of people focused on producing things of value. The other thing, which then so links in a little bit to the other area here, is the sort of new jurisdictions point and what they might decide to do. So I'm going to say the trouble at the moment with the financial industry, you've got people like me. So you've got too many intermediaries. We don't need that many intermediaries. I made a list here because I knew I'd never remember it. Right. So a list of the key institutions, financial institutions that we have in the developed world. And then I'm not going to go through each one now because I know we're short of time, but I think it's quite a good exercise to go through to think, will each of these still be relevant? Maybe a bit, maybe not a bit. How will they need to adapt what they do in that world I've just described in 30 years' time, when the world will look a little bit different in terms of what the options are? So I've got a list of 8 here. So central banks. So, obviously there's printing the base money, but there's also regulatory role there. So maybe they don't completely disappear. You've got banks and credit unions. So savings accounts, loans, mortgages. I think there's still some role there for the banks, it would seem to me, but there'd be a huge amount of pressure to not have fractionally reserve banking. Investment banks, essentially advisors to companies, to large corporations. There's still some role there because they'll still need to raise finance to fund their and raise equity, float themselves on the stock market. There's still a role there for them. Maybe it'll be less complicated. Custody and brokerage firms. Well, Bitcoin will still need to be held somewhere. Maybe the pound and the dollar, so on, still exists, so there'll still be some role there. The equities that are held, they still need to be held somewhere. Suggests to me there's a less of a role, and an adjustment to that role, but there's still a role. Insurance companies, I think there'll be a complete reevaluation of which risks do we want to insure. At the moment, we insure a lot of risks. It could be a house burning down, it could be the dog. When you retire, you could buy an annuity, and there's loads of different risks that are insured. I think there'll be a reevaluation of, are we getting value for money in each of those areas? I think there's definitely still a role for insurers, because I can imagine a scenario where I'm happy to put some money in with an insurer to last me a bit longer if I happen to live a bit longer than expected. I'm happy to pay a premium in case my house burns down. So there's definitely a role there, but I think that'll be reassessed. Investment managers, that's quite an interesting one, because the equity part will still need to be managed. And the Bitcoin probably falls under the custody rather than, it doesn't need full-on investment management. So that investment management is probably a role that dramatically reduces. Payment services. So we talked briefly about getting money overseas, like the Western Union and so on. Well, they probably are largely disintermediated. And financial advisors. I like to think there'll still be a role for them from a buyer's point of view, but I don't think as much.
Just have a card that says buy Bitcoin.
Yeah.
Just pass it over. Well, I mean, it's a good, but by that point anyway, it would be a very easy way to store value.
Exactly.
It'll stop us even having to think about any investing our money, you would hope, apart from in projects that actually do something.
But then you have to understand them a lot more and keep an eye on them and so on, so it's harder work. So I think for a lot of people, it'll be, let's say pounds are still around. just need some pounds and some Bitcoin. I feel I understand them enough. I don't need any of this other stuff that I'd never get my head around and have to keep looking at. So if you take that in the round, I think there's some changes involved for those different institutions. I think there are, overall, a reduced role. So I think there's less intermediation, which, if we think about the impact on society, you've got a huge number of clever people, smart people in the financial industry, and instead of applying themselves to where the bond price is going to go up or down the next day, they could apply themselves to creating the next skyscraper or coming up with the next piece of technology, or applying those incredible skills in some other way that produces stuff of what I'm going to say is real value, and could really change people's lives rather than, I think unfairly sometimes, but it's sometimes called paper shuffling. I don't think that's always true, but
pen pushing as well.
Yeah. But I think that's a little bit unfair in a few cases. But imagine that intelligence applied elsewhere, and that's a result of we've had to go down this road of having this complex and sophisticated financial sector because everyone is trying to beat inflation. If that is no longer an issue, so there's a fundamental cause there for it. If it's easy to do that, or if it's no longer you need to do it in a complicated way and still not beat inflation, then the use for a lot of that industry changes and some of it goes away.
What you're describing is actually a renaissance, I would say.
Yeah.
But it is.
Well, I think so.
Especially if that part about once people stop having to waste their time being investment brokers themselves, because they just buy Bitcoin, that's all they need to do, they can focus their attention elsewhere. And I like that side of it. I think that's I think I agree with you. And I don't agree that it's necessarily going to happen, but I don't see why it shouldn't, because if the Bitcoin thesis plays out, that's true. Like if once most, like I call myself a normal person, like most people like me can just buy Bitcoin and don't need to worry about anything else. That's what I'm going to do. 100%, and everyone I know would as well, because even when I was a kid, people used to put money in the bank and save money, didn't they? I was taught to save money. I wouldn't dream of doing it now. Putting money in the bank, it seems a crazy idea, And
I talked about how with just a bit of energy and Bitcoin enabling that, Africa and other places, it could make a dramatic improvement to their standard of living. Who's going to benefit most over here from a Bitcoin economy? It's going to be the poor. It's going to be the middle class as well. In particular, it is probably, by fixing the money, it's probably the most beneficial thing that could be done to society, bar none. And I think that's what gives a lot of people, unlike gold, which I think is it's understandable, and once being a gold bug, I sort of get this, but it's quite a pessimistic worldview. You think the whole thing's going to come crashing down. It's going to be terrible. I'm going to be scrabbling around, paying for a potato with a gold coin. It's not a pretty scenario. Whereas Bitcoin is incredibly optimistic. And I think that's why people feel so invigorated by it, because it's not perfect what they can see, but they can see a positive future. They can see light at the end of the tunnel, not just for themselves, but for their family and their friends who they can see are struggling for whatever reason. But if they trace it back, it's the money that's undermining their lives. And how good would that be for society? It'd be amazing. It'd be amazing. And it would be, as you say, a renaissance, the new renaissance.
I think we should leave it there. I like leaving on a high point. That was a lovely little speech at the end there. Amen to that. Yes, I agree. Bring on the Renaissance, mate. Sam, thanks for an interesting talk, and from your view from the institutional side, not one we get very often. It's been great talking to you.
Great to speak to you. Thank you.